19% year-on-year. Other retail growth remains strong at 27%. We're thus seeing loan growth momentum across segments. Deposit traction. Our retail deposit growth as per LCR accelerated to 21% year-on-year versus 19% in the previous quarter. Share of retail deposit improved to 43.4% versus 42.6% in the previous quarter. Our savings account book too grew by 6% quarter-on-quarter, reversing the attrition trend for the past few quarters. Overall, we achieved the total deposit growth of 15% year-on-year and 3% quarter-on-quarter, driven by granular retail growth. Continued investment in new initiatives. We continue to invest in our franchise both in physical as well as digital distribution, scaling up our presence in new products and customer segments. Our affluent deposits grew to 44,400 crores, up 22% year-on-year. NRI deposit grew to 37,200 crores, up 39% year-on-year. Our home loans pilot has reached 665 crores. We have hired around 12,600 employees in our distribution over the last 4 quarters. Improving asset quality. Our gross slippages reduced from 1,603 crores to 1,376 crore quarter-on-quarter. Our restructured book too reduced by rupees 475 crores from 0.84% to 0.66% quarter-on-quarter. Our net NPA is at 0.58% with a provision coverage ratio stable at 71%. Our contingent provisions are now at 1,700 crores with the total loan-related provision at 121% of gross NPAs. Sustaining profitability of the franchise. Our net interest margin improved by 1 basis point quarter-on-quarter and 8 basis points year-on-year to 4.29% with effective balance sheet management. Client fee income grew by 19% year-on-year, driven by continued retail momentum. Our PPOP margin to loans for the quarter was at 5.5% versus 5.6% quarter-on-quarter. Steady improvement in return ratios. Our profit after tax grew 4% quarter-on-quarter and 30% year-on-year to 2,124 crores. Our return on asset was at 1.90% and return on equity was at 15.24% for quarter 1. Our capital adequacy remains healthy with CET1 of 16.44% and overall CRAR at 18.4%. Now coming to financial performance for the quarter. Net interest income grew by 18% year-on-year and 4% quarter-on-quarter in line with the loan growth. Net interest margin improved at 4.29% versus 4.21% year-on-year and 4.28% quarter-on-quarter. Our income grew by 14% year-on-year and 3% quarter-on-quarter. Core client fees, excluding trading income, grew by 19% year-on-year and 2% quarter-on-quarter. We had positive non-core income of rupees 91 crores during this quarter. Share of retail fees improved from 73% to 73% from 70% year-on-year. Operating expenses grew by 6% quarter-on-quarter with cost to income ratio of 45.9%. The OPEX growth was driven by employee addition, investment in distribution, technology spends for the new platform launches and preparing for the annual appraisal actions. The operating profit for the quarter was at 3,831 crores, going up 12% year-on-year and 2% quarter-on-quarter. The PPOP margins to loans continue to be healthy at 5.5%. Core PPOP growth was at 14% year-on-year and 1% quarter-on-quarter. On the asset quality and the provisioning front, our provisions for the quarter have further reduced to 991 crores and are below 1,000 crore mark for the first time in last 3 years. The annualized provision to loans are thus down to 132 basis points now versus 142 basis points for the previous quarter and 155 basis points for the previous year. As expected, we saw a reduction in gross slippages from microfinance, corporate and other retail segments. The vehicle finance unit saw an increase in slippages given quarter 1 is seasonally weak than quarter 4. Overall, the GNPAs for the bank were at 1.94% and net NPAs were stable at 0.58%. We have maintained provision coverage ratio of 71%. Total loans related provisions are at 2.4% of loans and 121% of gross NPAs. Profit after tax for the quarter was at 2,124 crores, growing 4% quarter-on-quarter and 30% year-on-year. Our CRAR, including profits, remain healthy at 18.40%. Return on asset was at 1.9% and return on equity at 15.24%. Overall, the first quarter of our planning cycle 6 strategy saw progression towards the stated objectives. Loan growth was at 22% against our expected range of 18 to 23%. Seasonally, the first quarter is softer quarter for vehicle and microfinance businesses, and seasonality should support the loan momentum during the rest of the year. Retailization of liabilities continues with 21% growth in retail deposit as per LCR and healthy 6% quarter-on-quarter growth in SAR deposits. The share of retail deposit as per LCR improved to 43.4%, and we aim moving towards 45 to 50% in PC6. Asset quality improved in all business except for vehicle due to seasonality. The annualized credit costs are down to 132 basis points, inching towards our expected range of 110 to 130 basis points for the year. All key profitability metrics across NIMs, PPOP margin, ROE have maintained healthy position and are in line with the communicated aspirations. We continue to scale up new initiatives like affluent, NRI, tractors, merchant acquiring, home loans, and digital launches. These provide further growth avenues for the bank. We have thus begun well on a PC6 strategy execution and are committed to the ambitions outlined in our strategic plan. We can now open the floor for question and answers.
Junaid from Moneycontrol. Yes. So you had previously said that you'll be meeting a couple of days, after some days, concerning fundraising. So wanted to understand some clarity if you could give in as to what the purpose is and what's the amount you're looking at.
We are not raising any funds. So we do put a clause in our AGMs every year for our borrowings to be raised at a certain point. So we have not, and that's an enabling clause. We are well capitalized as of now, and we don't believe that we need to do a fundraising or a capital raising right now.
Does this mean that your promoters who've gotten a go-ahead from the RBI to take stake to 26, you're not in any rush, or they're not in any rush to invest in the bank immediately, they'll wait it out? And the bank has also stated pretty much in the past that there are intentions to get into insurance, asset management, wealth management, and so on. Would this inflow of money that comes in be deployed into parabanking activities rather than more banking?
So we don't have the license for parabanking as of now. So unless and until we get a license for parabanking, we can't talk about it. That's number one. Number two, like I said, we are well capitalized as of now, and we don't need the capital. For promoter to infuse funds into us, I think we need to first decide what is the source of, what capital do we need at any point of time. We don't need capital as of now. And I think the question of raising capital does not arise.
I would also like to ask one question regarding your business side. On the CV segment, where exactly presentation is not uploaded on the website, on the exchanges. We couldn't see the numbers here as well. So if you could take us through how the buckets are functioning there. And there's been quite a lot of demand, or rather supply, from NBFCs as well. A lot of them have rebounded, so have the small finance banks. So how is your pricing today on the CV segment vis-a-vis the entire competition?
So we operate in a very different segment, and we operate in what we call as the SRTO segment. And I think we have a very good positioning in that segment, and we operate in tier 3 to tier 5 cities in a majority manner. If you look at the top two players, and you will see that the top two players have never lost market share in this segment because of their ability to continue with the business over the cyclical downturns. We've been in this business for 33 years, and we believe that we have loyal customers who continue to be with us during up times, bad times, and good times.
On the asset quality front, sir?
So the asset quality, we've always said that the asset quality, the gross NPA, this is a seasonal factor. The gross NPAs are higher at this point of time. It's about 2.2% gross flows. But the credit cost for the overall will come around 1% for the year. So I think we've always said in good time they operate at 90 basis point, in bad time they operate at 120 basis points credit cost. So we will end this year at 100 basis points of credit cost.
Great. One last question, if I'd be allowed. All your competitors are looking at MFI from an acquisition perspective. You have a good book, 10% of total loans. Would you want to ramp it up further, or you're happy at where MFI portfolio is at this juncture?
We've always said MFI will be around, we have got a benchmark hurdle rate of 15% of our book should be MFI. We are at 11% now, as of now. So we will ramp up MFI, but I think our ability to ramp up will depend on how the different markets operate and how the portfolio is behaving. So we are not, we continue to maintain 10 to 11% market share in the MFI book, and that's where we will be in the 10 to 11%. We don't need to grow faster than that in the MFI business. What we are doing, we are diversifying into what we call as micro banking. And we are adding new products into our bouquet in the rural areas. So we've done merchant acquiring as one product in the Bharat Financial. And that book is around 4,250 crores, which is a very, very nice business which we've created. We will be launching further new products as we grow the scooter loan portfolio, the home improvement. So we have decided on that. And I think you will see a diversification of the book while we maintain a steady on the JLG. So the book overall for the year will grow at 28 to 30. It does not necessarily mean that JLG business will grow at 28 to 30%.
Thank you.
Mr. Katpalia, Anurag from ET Now.
Yeah.
So my first question is that the promoters are planning to increase the stake in the bank from 15% to 26%. Where do you reckon the capital adequacy of the bank after the fund infusion? And the second question is that one of the targets the promoters, IndusInd International, had was to complete the capital infusion in the second quarter. So have you got any kind of an assurance from the promoters on this that it would be completed by September 30?
So we've not had capital discussions with the promoter because we're not planning to raise capital. So this is a question which I cannot answer. And you must ask the promoter directly for that question. Having said that, we've always said that we will maintain adequate CET1 and we will raise capital only if our CET1 falls below 14%. We are very well capitalized as of now. We're at 16.5%. We don't see any need for capital, and we've not discussed any plans with the promoter on when and how the capital will be deployed and why we need the capital as of now.
Hello. Sir, Anurag this side. Sir, my question is that IndusInd Bank is planning to foray into insurance and mutual fund business, and what would be the timeline? And sir, you will be applying for a new licenses, or you will try to buy some existing players?
We don't have a license as of now. So the question of us foraying into insurance and mutual fund will only arise if the regulator gives us a license. And I don't think we have the license as of now.
So you're willing to, have you reached to regulators for the license?
We have an ongoing discussion with the regulator, but there is no confirmation or from them that we will get the license. So I think we have to wait for the license to come in before we commit to the market that we are foraying into that business.
And sir, there is no definite timeline for
There's no definite timeline for that.
Okay.
So just to add to that question, your promoters have bid for, Reliance Capital, which also includes mutual fund insurance. Is there any conversation at the board level or with the regulator to merge it with the bank or bring it under the bank? Is there some conversation?
Not at all. Not at all. I think it's an independent activity done by the promoter, and any questions regarding Reliance Capital has to be discussed with the promoter.
Hi, Siddhi here from Reuters. I was just looking at your advances and deposit growth. There's still some kind of discrepancy there. There's a mismatch. I mean, your advances growth is higher than the deposit growth. So if you could just throw some color on how your deposit mobilization strategy will be in the coming quarters.
So if you look at our deposit growth, you have to see the retail deposit growth. We are focused on granularization of the liabilities. Our retail liability growth, if you look at it, is as per it says 21% growth. And I think as long as we are doing that, I think we are very fine in the business. And I think that is what our focus will be. And I think We have plans to continue to grow at a fast pace on that business. We just about launched our digital platform for the business which we call Indy. Yesterday we did the employee launch last month, and we now launched we've done a soft customer launch yesterday. And I think that's a business where we think the scale will happen in our business, and we've got other different initiatives to scale up liabilities.
So any targets if you can help with?
We've always said that we want to be at in the planning cycle 6, where we've disclosed the number. I think our retail LCR would be around 45 to 50%, and in CASA ratio we should be around 43 to 45%.
And so on the NIMS front, right now it's 4.28 if I'm not wrong. Any targets on that? Is this sustainable going forward? How would
We've always said our NIMS will be range bound between 4.2 to 4.3. And if you look at our slide and some of the vectors, you will see we are very stable on our various parameters on which we assess our business. Can you just show the slide 16? Yeah. So as he brings up the slide, you'll see that all our parameters which are related to NIM, to ROA, ROE, you'll see a very stable performance out there. So net interest margin, we are very stable. We will remain between 4.2 and 4.3. If you look total fee to asset ratio, we are at 1.9, very stable. Our cost to income ratio is between 43 and 45%, and we will end up with that range itself. Our operating profit margins are between 5.5 and 5.7. So we are very, very stable as an institution on all our margins. It's there in the investor presentation. We can show it to you. Yeah. So this is our loan book, and 54-46 is the mix. I think 54% in consumer. The domain specializations is where our business is concentrated on. We believe that domains gives you pricing power as well as loyalty, and I think that's where our business is.
So what were the slippages, gross slippages for this quarter? How do they compare? And specifically with vehicle finance, where you spoke about the seasonality, what was it there?
So our gross slippages in quarter 4 were about 1,603 crores. And in quarter 1 is 1,376 crores. Out of that, the gross slippages in the CFD book, which is the vehicle finance book, was around 581 crores against a quarter 4 of 599 crores. 383 crores.
So Q4 was 383 crores?
Yes.
And so secondly, like you spoke about the entire questions about capital, about what the promoter would be doing with Reliance Capital, whether they'll be working together or not, or you address those. Like how should we really look at this? Because promoter is going out, making their plans, and like giving timelines as well. So how do you want us to look at this? Because the bank is saying that it doesn't need...
Talk to the promoter. The bank is an independent entity. Bank does not have any plans to raise capital as of now.
Are you waiting for valuations also to come back on that note? You're closer to getting there to 2. Would you want
But I have to... So you're putting words into my... Let me put it in a very different way. We don't need capital. We are very well capitalized as of now. Do you think a bank which has 18.40 as capital adequacy ratio will need capital? Why would you need a capital? And our internal accruals are enough, and we'll continue to add to the capital. So please understand, our utilizations, our risk-weighted assets have gone down. So your utilization of capital has gone down as a consequence. If you see last quarter, we were at 17.6. We are already at 18.4 because of the risk-weighted assets going down. And we balance our portfolio in such a way that our risk-weighted assets of the portfolio continue to show a decline.
If I can ask one question about the cards business, sir. This was something that you grandly entered into about a year and a half back.
Cards?
credit cards.
So we entered it
Not
into...
entered into, that was an acquisition that came into the bank, but ramped up your plans as such.
Yeah.
You came up with a lot of tie-ups, you went into the premiumization mode. It's been about 1.5 years now, and if I look at the league tables on the card, the disparity between the number third and the number fourth player itself is very huge, and you're somewhere between the fifth and the sixth. How are you going to shrink that? You're about 22,000 in terms of carding base. So what is your plan there? Is that something that you want to keep as an elite product or a growth product?
So I think it's a question which we've been asking ourselves also. So card as a business is a very engaged product, and it creates customer life cycle. We are in our portfolio is 3% of our book as of now. The issue with this is that we've always said that personal loan and cards will not be more than 5% of our book, because we have a microfinance portfolio which is actually 13 to 14% of our book. So that ends up at 20% of our book. So that's the unsecured exposure which we want to take in our book. So at some point, if we see our MSME and the mortgage book scaling up, we will definitely scale up cards at that point of time. Otherwise, we will never cross the 5% barrier on the overall unsecured in the non-MFI unsecured business.
Hi, Jaspreet here. So I just wanted to, I don't know if I missed this in your opening remarks, but could you help me with your corporate loan growth over the quarter year on year, maybe on a sequential basis as well? And could you also indicate where the demands in the corporate sector seems to be coming from, given the current progress in the CapEx cycle as well?
So we grew the corporate book at 22% year on year and 4% quarter on quarter. I think the growth happened in the MSME and the SME side of the business, where we grew at 10.4%. The large corporate grew at about 3.5% for us.
Okay.
Quarter on quarter.
And is pricing one of the sticking points in the large corporates market currently? Because recently we've seen commentary from different banks saying pricing has been disrupted. It's becoming a sticking point, especially for the large corporates. How are you looking at the pricing?
See, we play in areas where we have a right to win. We actually are very clear about it. So if you look at us, we're not going to be there in every deal on any deal. We structure the deal in such a way that we have a transaction banking product or a global markets product making up for the loss in yield. So we look at the RORWA of the corporate bank rather than looking at individual yields in isolation as a consequence. And I think if you look at that way, I think our corporate bank RORWA is above 2% as of now. And that is what we want in a corporate bank, whereas the other businesses will offer us a different RORWA. So I think that's our strategy, and we play in different areas, and we create a separate niche for ourselves in playing in those areas.
And you'd expect that 2% to be sustained over FY24? No.
That's a hurdle rate which the board has set. Below that, we will not do it.
Okay, thank you.
Now, and this is because of retail expansion, branch expansion, so on. Is it also in anticipation of the kind of competition that you would now expect in this market from the combined entity HDFC Bank? Is there some thinking on those lines as well when you're looking at such a...
Not at all.
Okay.
We don't compete with HDFC and ICICI. We have to understand every bank will have its own strength and weakness. We play the liability games in a very differentiated manner. So if you look at it, I talked about affluent, I talked about NRI, we'll talk about communities maybe in the next forum. I talked about a digital bank coming into play. We will do things in a very differentiated manner. Of course, we have to plan expansion on our distribution, but it's not only the branches. We've expanded in the rural areas where our microfinance business is growing. So we added about 8,000 people in our microfinance unit over the last 1 year. So I think it's not only about consumer expanding the branch network, we're also expanding in the rural areas. So we have niche segments in which we operate, and we build our expertise in that segment. If we try and copy a larger bank distribution or a larger bank capability, I think our cost to income ratios will look very, very bad. So we have to understand what we are doing, where we have a right to win, and we play in those segments and get our market share done.
And how is your home loan book shaping up now?
So I just announced it. We have a 650 to 675 crores of book. It's only in a pilot phase right now. We want to observe for the next 3 to 6 months how the delinquencies and the flow rates behave, and then we'll scale it up. our target for the next 3 years is to create a 15,000 crore home loan book in the business.
Sorry, I just had a quick follow-up on the corporate lending section. How much of the MSME lending is secured versus unsecured?
We only do secured.
Only secured?
We don't do unsecured. We're not into the unsecured segment. Sorry? We make more than 2% on the MSME side. It's a very, very profitable segment for us. So we believe that we have OEM tie-ups. That grows the book. We operate in the tier 3 and tier 4 cities in the book, and we're making a lot of. There's also a book which we've created in the used car vehicles, and I think that's around 4,500 crores of book. That's also giving us a very good yield. So we continue to believe that used car is personal mobility is a very important segment. In that, used car is a very, very important segment, and we are playing in that segment and also in the new car segment. I never made that statement. Talks are going on. There is no talk with the insurance regulator. Again, I'm saying I've never said that. We've not decided. So we don't have the license for anything for us to decide what we want to do. Yeah. So if there's no other questions, I think we'll close the call. If you have any questions, you can contact Indrajit or me, or we are available for any other questions.
Benchmark.
So what is the portion of your book? I think if you look at it, we have a 48-52 mix. 52% of our book is fixed rate book and 48% of our book is floating rate book. In the floating rate book, it's about 40% of our book is EBLR and 60% of it is MCLR right now. Yep. Thank you.